The Securities and Exchange Board of India, or SEBI, was first established on April 12, 1988. It began as a non-statutory body. Its primary objective was to regulate the securities market. Another key goal was to protect the interests of investors in securities. However, in its initial phase, SEBI operated without full legal authority. This limited its ability to enforce regulations effectively. The need for a more powerful regulatory body was becoming increasingly apparent as the Indian market grew and faced various challenges. The early years were formative, setting the stage for a more robust framework. Before SEBI gained significant powers, the Indian capital market was often described as a difficult environment. It was plagued by several malpractices. Price rigging was a common concern, distorting fair market values. Unofficial private placements of securities occurred without proper oversight. Insider trading allowed those with privileged information to profit unfairly. These issues eroded investor confidence and hindered the healthy development of the market. There was a clear and pressing need for a strong, independent regulator to instill discipline and transparency in the system, ensuring a level playing field for all participants involved in the market. Once armed with statutory powers in 1992, SEBI embarked on a mission to cleanse the Indian capital markets. The immediate focus was on addressing the widespread malpractices that had been highlighted by previous scams. This period was characterized by a series of foundational reforms. These reforms aimed to establish a fair and transparent market environment. SEBI began by formulating regulations to curb unfair trade practices. It also started to build an infrastructure for better market oversight. The task was immense, akin to cleaning the Augean stables, but SEBI was determined to bring order. A crucial step in these early reforms was the regulation of market intermediaries. SEBI brought various entities under its regulatory purview. Mutual funds were regulated starting in 1994. Merchant bankers also came under SEBI's oversight in the same year. Foreign institutional investors, or FIIs, were another key group that SEBI began to regulate from 1994. By standardizing the operational practices of these intermediaries, SEBI aimed to enhance accountability. This ensured that these entities adhered to ethical standards and protected investor interests, which was a paramount concern for the newly empowered regulatory body. A revolutionary reform during this period was the introduction of dematerialization of shares. The National Securities Depository Limited, or NSDL, was established in 1996 to facilitate this process. Dematerialization involved converting physical share certificates into electronic form. This move had numerous benefits. It significantly reduced the extensive paperwork associated with physical shares. It also curtailed the risks of theft, forgery, and damage to certificates. Furthermore, dematerialization increased the efficiency of trading and settlement, making transactions quicker and more secure for all investors. Another significant regulatory action was the banning of the Badla system in 1998. The Badla system was a traditional carry-forward mechanism prevalent in Indian stock exchanges. While it provided liquidity, it also contributed to excessive speculation and market volatility. Its opaque nature was a concern for market integrity. SEBI's decision to abolish Badla was a move towards a more transparent and modern trading system. This reform aimed to reduce speculative excesses and align Indian market practices with international standards, thereby fostering a healthier investment climate for everyone involved. The dawn of the new millennium signaled a shift towards embracing modernity within the Indian capital markets. SEBI played a pivotal role in championing technological advancements and enhancing transparency. A significant milestone was the launch of the derivatives market in June 2000. This began with the introduction of Nifty futures. The introduction of derivatives provided market participants with new tools for hedging and risk management. It also added depth and liquidity to the Indian markets. SEBI's proactive approach ensured that these new instruments were introduced within a regulated framework from their inception. During this decade, SEBI also focused on strengthening corporate governance and bolstering market integrity. In 2001, critical updates were made to the insider trading regulations and the takeover code. These revisions aimed to prevent illicit gains from non-public information. They also sought to ensure fairness and transparency in corporate control transactions. By refining these codes, SEBI sent a clear message about the importance of ethical conduct. It emphasized that fair play was essential for maintaining investor confidence and the overall health of the market, which was crucial for long-term growth. Enhancing market efficiency was another key priority for SEBI between 2000 and 2010. A major step in this direction was the implementation of the rolling settlement system. Initially, T+3 was introduced, and then it was further shortened to T+2 in 2003. This meant that trades were settled within 2 working days after the trade date. Shortening the settlement cycle significantly reduced counterparty risk. It also improved liquidity in the market, because funds and securities were released faster. This reform aligned Indian market practices more closely with global standards, making the market more attractive. To further increase transparency and accountability, SEBI made the Permanent Account Number, or PAN, mandatory in 2005. This requirement applied to all participants in the stock market, including investors and traders. The mandatory use of PAN allowed for better tracking of financial transactions. It also helped in curbing illicit activities such as money laundering and benami transactions. This measure was instrumental in creating a more transparent financial ecosystem. It also aided regulatory authorities in monitoring compliance and ensuring the integrity of market operations remained intact for all participants. The decade from 2010 to 2020 saw SEBI intensify its efforts to fortify investor trust and deepen the Indian capital markets. A significant move in this direction was the tightening of norms for initial public offerings, or IPOs, in 2012. These revised guidelines aim to improve the quality of public issues and protect the interests of retail investors. Simultaneously, SEBI introduced the applications supported by blocked amount, or ASBA facility. ASBA ensured that an investor's application money remained in their bank account until shares were allotted. This minimized the risk of misuse of funds by intermediaries. Enhancing corporate governance standards for listed companies remained a key focus for SEBI. In 2014, the regulator implemented the rule mandating a minimum 25% public shareholding for all listed companies. This reform was aimed at broadening public ownership of listed entities. It also sought to reduce the concentration of control in the hands of promoters. A wider public float generally leads to better price discovery and increased market liquidity. This measure contributed to making the Indian stock market more democratic and representative of a broader investor base, enhancing overall market quality. SEBI also took steps to introduce new investment avenues for investors. In 2016, real estate investment trusts, or REITs, and infrastructure investment trusts, or INVTs, were launched. These instruments allowed investors to participate in the income-generating real estate and infrastructure sectors without directly owning the physical assets. REITs and INVTs provided new asset classes for portfolio diversification. They also served as a crucial mechanism for channeling funds into infrastructure development, which is vital for the country's economic growth. This innovation broadened the investment landscape considerably. The regulatory ambit of SEBI continued to expand during this period. In 2017, commodity derivatives trading was brought under SEBI's oversight following the merger of the Forward Markets Commission, or FMC, with SEBI. This unified regulation of securities and commodities derivatives markets aimed to create synergies and strengthen regulatory supervision. Furthermore, in 2018, SEBI implemented a reclassification of mutual fund categories to bring uniformity and clarity for investors. Norms for credit rating agencies were also tightened in the same year to improve accountability and the quality of ratings. Section 5. Navigating New Challenges. Surveillance and Recent Regulations from 2020 to 2025. The period from 2020 to 2025 presented SEBI with new and complex challenges, demanding adaptability and proactive regulation. The onset of the COVID-19 pandemic in early 2020 caused unprecedented market volatility. Markets experienced a sharp crash followed by a significant and sustained bull run. This period also witnessed a massive influx of new retail investors into the market, drawn by the potential for quick gains. SEBI had to navigate this dynamic environment carefully. It focused on maintaining market stability while ensuring investor protection amidst heightened participation and uncertainty. To address potential systemic risks arising from increased leverage, SEBI introduced the peak margin rule in a phased manner starting in 2020. This rule stipulated that brokers must collect upfront margins from clients for their trades, even for intraday positions. The aim was to reduce excessive speculation and mitigate the risks associated with high leverage in intraday trading. While the rule initially faced some resistance from the trading community due to reduced leverage, it was a crucial step towards enhancing market stability and protecting both brokers and investors from potential defaults during volatile periods. SEBI continued to enhance security features and risk disclosure mechanisms for investors. In 2021, the mandatory use of TPIN, or Transaction Personal Identification Number, for DMA account debits was introduced. This added an extra layer of security for investor holdings. The same year, SEBI mandated a riskometer for all mutual fund schemes. This tool visually represents the level of risk associated with a scheme, helping investors make more informed decisions. Furthermore, a new margin framework and stricter surveillance of brokers were implemented to strengthen the overall market infrastructure and safeguard client assets effectively. Further advancing market efficiency, SEBI initiated the phased rollout of the T+1 settlement cycle in 2022. This meant that trades would be settled on the next trading day, further reducing settlement risk and freeing up capital more quickly. This move placed India among a select few countries with such a short settlement cycle. SEBI also continued to refine regulations for mutual funds, with further tightening of classification rules in 2022 to ensure schemes were true to their labels. These proactive measures demonstrated SEBI's commitment to evolving with market needs and global best practices for enhanced protection. Section 6. The Metamorphosis of India's Equity Landscape. Key milestones from 1988 to 2025. The journey of India's equity market from 1988 to 2025 is a story of remarkable transformation. The pre-reform era was well characterized by inefficiencies and a lack of transparency. The Harshad Mehta scam in 1992 acted as a significant catalyst for change, leading to SEBI gaining statutory powers. A major technological leap occurred in 1994 with the launch of electronic trading by the National Stock Exchange. This revolutionized market access, making trading more efficient and transparent for participants across the country. It marked a decisive shift from the traditional open outcry system to a screen-based trading environment. The dematerialization revolution, initiated with the formation of NSDL in 1996, fundamentally changed how securities were held and traded. It eliminated physical certificates, reducing risks and costs. However, the market faced another challenge with the Khatan Parekh scam in 2001, which prompted further regulatory tightening by SEBI. The mid-2000s saw the rise of online trading platforms, with brokers like Sharekhan and ICC Direct making it easier for retail investors to participate directly in the market. This period witnessed a gradual democratization of equity investing, extending its reach beyond traditional financial centers. The Indian equity market demonstrated resilience during the global financial crisis of 2008, though it experienced a significant correction. The subsequent years saw the emergence and growth of algorithmic trading, starting around 2010. This brought new levels of sophistication and speed to trading operations. A notable increase in retail participation was observed post-2014, partly influenced by a new government and favorable market conditions. This trend indicated growing investor confidence and financial literacy among the general populace, expanding the market's depth and breadth significantly. The COVID-19 pandemic beginning in 2020 led to unprecedented market dynamics. After an initial crash, a massive bull run attracted a new wave of retail investors. By 2023, a significant milestone was reached when retail trading volumes in the futures and options segment surpassed those of institutional investors. Looking ahead to 2025, it is anticipated that retail participation in AI-based trading strategies will increasingly dominate market volumes. This ongoing evolution presents both opportunities and challenges for regulators like SEBI, requiring continuous adaptation and vigilance to maintain market stability. Section 7. The Ascent of Derivatives, the Futures and Options Market Saga. The introduction of exchange-traded derivatives marked a significant evolution in the Indian financial markets. The journey began in the year 2000 with the launch of index futures based on the Nifty 50 index. This was a landmark step, providing market participants with a tool to hedge their portfolio risks against broader market movements. Following this, stock futures and stock options were introduced in 2001, further expanding the range of derivative instruments available. The initial days of the F&O market were focused on establishing infrastructure and educating market participants about these relatively complex products. The derivatives segment witnessed gradual expansion in its early years. In 2004, weekly options were introduced, offering shorter-term hedging and trading opportunities, which quickly gained popularity among active traders. For a considerable period, roughly between 2010 and 2019, institutional investors were the predominant participants in the futures and options market. Their participation provided liquidity and depth to the market. These large players used derivatives extensively for sophisticated hedging strategies, arbitrage, and directional trading, contributing significantly to price discovery in the underlying cash market. The period from 2020 onwards witnessed an explosion in retail participation in the F&O segment. Several factors contributed to this surge. The rise of zero brokerage platforms such as Zerodha and Grow significantly lowered the cost of trading. The increased accessibility of mobile trading applications made it convenient for individuals to trade from anywhere. Furthermore, the fear of missing out phenomenon, especially during the sharp market recovery post the initial COVID-19 impact, drew many new and often inexperienced investors towards the perceived high returns of F&O trading. This dramatic increase in retail activity in derivatives, particularly options trading, raised concerns for SEBI. Studies indicated that a vast majority of individual traders in the F&O segment were incurring losses. Consequently, SEBI initiated several regulatory actions between 2022 and 2025. These included measures to restrict F&O exposure for retail investors and extensive campaigns to promote awareness about the inherent risks. As of 2025, SEBI continues to actively review proposals for managing risks in this rapidly expanding segment, aiming to strike a balance between market development and investor protection. Section 8. SEBI's Vigilance in the Modern Era. Key Circulars and Actions from 2020 to 2025. In its ongoing efforts to protect investors and enhance market integrity, SEBI introduced several important regulations between 2020 and 2025. In 2023, the regulator tightened the rules concerning additional Tier 1 perpetual bonds. This move emphasized the need for proper valuation of these complex instruments and mandated clearer risk disclosures to investors, particularly after some instances of mis-selling and unexpected write-downs. During the same year, SEBI also introduced new rules for environmental, social, and governance investing, providing a framework for green financing and disclosures. Regulations for proxy advisory firms were also updated to improve their accountability. The rapid rise of financial influencers on social media, presented a new regulatory challenge. To address concerns about potential mis-selling and unregistered investment advice, SEBI established an advisory framework for finfluencers in 2023. This framework aimed to bring more transparency and accountability to their activities. By 2024, SEBI had taken strict action against several unregistered investment advisors and finfluencers who were found to be violating regulatory norms. These enforcement actions underscored SEBI's commitment to protecting retail investors from misleading advice and ensuring that investment guidance comes from qualified and registered professionals. As of June 2025, SEBI is actively engaged in reviewing its ESG disclosure framework. This was announced by SEBI Chief Tuhin Kantapande around April 2025. The review responds to industry concerns regarding the complexity and reporting burden associated with current ESG norms, particularly for smaller listed companies. The aim is to achieve optimal regulations. Currently, ESG disclosures under the Business Responsibility and Sustainability Reporting Framework are mandatory for the top 1,000 listed companies by market capitalization since fiscal year 2022 to 2023. The largest 250 firms are also required to disclose sustainability metrics for a significant portion of their supply chain partners by fiscal year 2025 to 26. SEBI also continues to place strong emphasis on compliance with its insider trading regulations, specifically concerning the maintenance of a structured digital database. This database, mandated by Regulation 3, requires listed companies to maintain a non-tamperable, time-stamped, and audit-traceable digital log of unpublished price-sensitive information. Non-compliance can lead to severe penalties. Furthermore, in 2025, SEBI is reviewing disclosure requirements related to related party transactions to enhance transparency. An important step in empowering investors was the implementation of an investor charter in 2024, clearly defining their rights and responsibilities. Section 9. Conclusion: SEBI's enduring legacy and the path ahead. The journey of the Securities and Exchange Board of India from its inception in 1988 to 2025 has been truly transformative. It evolved from a non-statutory body with limited powers into a formidable and respected overseer of India's capital markets. SEBI's pivotal role cannot be overstated. It has been instrumental in shaping a market that is modern, transparent, and increasingly aligned with global standards. The regulator has navigated numerous challenges, from market scams in its early days to the complexities of a digitally driven financial world today, consistently striving to protect investor interests. SEBI's success is evident in the significant development and modernization of the Indian markets. It has fostered an environment conducive to growth by introducing key reforms such as dematerialization, electronic trading, and shorter settlement cycles. The regulator has worked tirelessly to enhance corporate governance standards and improve transparency and disclosures. These efforts have not only boosted investor confidence, but also attracted significant foreign investment into India. The depth and breadth of the Indian capital markets today are a testament to SEBI's proactive and diligent regulatory approach over more than 3 decades. A key aspect of SEBI's functioning has been its ability to strike a delicate balance. It has consistently sought to encourage innovation, whether in the form of new financial products like derivatives and REITs, or by embracing technological advancements like fintech solutions. Simultaneously, SEBI has remained steadfast in its primary mandate of robust investor protection. This balancing act is an ongoing challenge, especially in a dynamic market environment characterized by rapid technological changes, increasing retail participation, and evolving global financial landscapes. SEBI's adaptive regulatory strategies have been crucial in this regard. Looking ahead, SEBI is well prepared to address the future of India's capital markets. This includes navigating the implications of AI-driven trading, promoting sustainable finance through ESG considerations, and managing the risks associated with the burgeoning retail participation, particularly in complex segments like derivatives. The regulator's commitment to fostering a fair, efficient, and secure market remains unwavering. SEBI's enduring legacy will be its contribution to building a resilient and trustworthy financial ecosystem that supports India's economic growth and empowers investors to participate with confidence in the nation's progress.